Have you ever wondered how decisions made by the Federal Reserve, or the Fed, impact the economy and markets? As the Central Bank of the United States, the Fed wields considerable influence on our financial lives, whether we realize it or not. Its decisions on interest rates and monetary policy can send ripples across the globe, affecting everything from the stock market to the value of the dollar. When the Fed alters interest rates, it not only affects the returns on your savings account, but it also influences investment decisions and overall market sentiment. For instance, a rate hike can cause a pullback in stock prices, while a rate cut might stimulate them. The Fed's decisions also have a significant impact on currency exchange rates. Changes in monetary policy can sway the value of the US dollar relative to other currencies, affecting everything from the cost of your overseas vacation to the price of imported goods. And let's not forget the overall economy. Interest rates have a direct bearing on borrowing costs for businesses and consumers, which in turn impact economic growth and inflation rates. Higher interest rates can make loans more expensive, potentially slowing economic growth, while lower rates can stimulate spending and investment, potentially leading to higher inflation. In essence, the Fed's decisions can significantly sway the financial landscape. The recent Federal Open Market Committee meeting has been a focal point for investors and financial institutions worldwide. This gathering of economic powerhouses made a pivotal decision to maintain the current federal funds rate target range at 5.25 to 5.5%. This move comes on the heels of a series of 11 rate increases that were implemented between 2022 and 2023 to combat inflation. Now, let's take a moment to understand the implications of this decision. By holding the rates steady, the Federal Reserve is signaling a pause after a period of aggressive action against inflation. It's a bit like taking a breather after a vigorous uphill climb. But here's the thing. Inflation is still a major concern. It's been slowing down since its peak in mid-2022, but it's still higher than the Fed's target of 2%, so the fight is far from over. Federal Reserve Chair Jerome Powell made this clear in his press conference. The Fed is still committed to battling inflation, but they're going to keep a close eye on the economic data before making any future rate changes. The Fed's cautious approach suggests potential volatility in the market. This decision may not have been what some investors were hoping for, but it's a reminder that the path to economic stability can sometimes be a winding one. The Fed's decisions often trigger immediate reactions and shape future expectations in the market. When the recent decision to hold interest rates steady was announced, the initial market reaction was one of disappointment. Investors, who had been hoping for a signal of an upcoming rate cut, were met with a slight dip in stock prices. But the market's focus swiftly shifted to Chair Powell's press conference. Investors were keen to decipher any clues about the Fed's future trajectory. Powell's comments about the Fed's continued commitment to fighting inflation suggested that any potential rate cuts might be further down the line than some had anticipated. Looking ahead, the long-term outlook for the markets and the economy is still being shaped. The Fed's ongoing battle against inflation and how it navigates this challenge will play a substantial role. While some clarity has been provided, the path forward is still dependent on upcoming economic data and the Fed's assessment of inflation control.